V Vaidyanathan, Managing Director and CEO of IDFC First Bank. Before Mr. Vaidyanathan, good morning. Thank you for joining us. I was thinking about it when I was preparing for the interview that life's been a full circle for you. I mean, from being a banker to an NBFC promoter, now to being a banker promoter, it must be a great feeling, right?
It feels wonderful, but I don't use the term banker promoter, certainly not. But yes, indeed, as a non-banking finance company, our eventual ambition was to convert to a bank. So this was a great opportunity, and I think it worked well for both parties.
The numbers are not comparable, and that's largely because the merger integration is at place. And frankly, markets are not going to judge you based on what we've got in terms of numbers. But markets would like to understand from you that what are the three things you would do? How will you hit the ground running to make sure that IDFC Bank migration and Capital First migration is well received?
If you don't mind, just before we come to the question, for the benefit of viewers, can we just set some base about what the numbers as a result of the merger are and what the combined entity looks like, and then I will straight jump into your question, if you don't mind.
Go ahead.
So basically, as a result of the merger, the loan book of the bank actually has moved from rupees 75,000 crores last quarter, that is Q2 2019, to 1,04,600 crores. That's a substantial jump. Second is the retail loan book has increased from rupees 9,900 crores to rupees 36,236 crores in this quarter because of the merger. Number three, the retail proportion as a percentage of the book has increased from 13% in Q2 2019 to 35% in Q3. That's a big straight jump of retail, which is diversified. And number four, the net interest margin has increased from 1.7% last quarter for IDFC Bank standalone to 3.27% now, which is rather healthy as IDFC First Bank. So I wanted to put these numbers out of the way, and then I'd take your questions from here on.
I mean, it's important for us to set the base and then build on that base. My next obvious question would be, is that there is a long-term vision and there is a short-term view. So first, your long-term vision was very well articulated by you when the merger was announced, and we've interacted and we've talked about it on the various forums. But in next 3 to 4 quarters, what should we see and expect from the merged entity, both in terms of synergies, cost saving, and then client leveraging?
No, it's absolutely the appropriate question. In the short run, let me say in the next 1 year, mainly the integration processes are in play. Secondly, I'm very happy to share with all viewers that the integration is progressing perfectly on expected lines. The two organizations have come together. We've integrated the people, integrated the technology, integrated the processes, integrated the risk management systems, integrated the operations. All these processes have the big building blocks, so to say, have actually been put in place. This integration process, of course, will go on for 1 more year, but I'm happy to share with you it's progressing very well. Number two, what has happened is that because of the merger, as I described to you a moment ago, the coming together of the Capital First loan book of close to about 30,000 crores has added straight profitability to the franchise, because that business was generating a return on equity of close to 15 to 15.5%, and that has, let me say, lifted or given a strong base to the future earning numbers. Number three, I must say that the core IDFC Bank model, let me say erstwhile IDFC Bank model of building and rolling out the retail bank branches and building the technology platform for rolling out is really excellent. And that base, coupled with the retail lending base of Capital First, let me say, if you wanted to get a picture of the next 12 months, I'd say the retail loan book could grow by about 25%. If you take a 4 quarters forward of the wholesale loan book, we think it would be rather flat, because infrastructure will degrow and corporate will grow. So blend of it would probably be flat. And as a bank, I think the big focus 4 quarters will be growing CASA and retail deposits.
The fight for CASA And the desire to grow retail, I guess, is something which everybody is trying to adopt, whether it is banks or NBFCs or even small banks. Do you think there is enough and more scope for so many various financial entities to coexist, and do you think you will be able to gain enough and more market share there?
First of all, it's a very big opportunity. I must share some numbers with you. The CASA numbers in the market are 47 lakh crores, of which close to about 37 lakh crores is savings account balances alone. To start with, for our bank, our savings account balances are only about 6,400 crores. I use the word only because it is just the start of the bank as far as this process is concerned. And on that sort of a large marketplace, it's really an opportunity where you can really swim into. Number two is in terms of whether we can scale this up. Certainly we feel so. Last month we launched a program where we started giving 7% to customers having saving balances with us in excess of ₹2 lakh. Rates alone don't get customers, but I think we're putting together a series of steps with regard to how we can achieve that. Our key focus over the next few years, and certainly for the next 4 quarters, and even if you take a 5-year forward, is CASA retail deposits. That is our key strategy, because as I said to you, the lending business is in really great shape and there is no reason why they should have a problem on that front.
What is your take on IDFC Bank's asset quality? Because a lot has changed when you first analyzed it, and how IBC laws and NCLT laws have changed. Where do you think the asset quality of IDFC or erstwhile IDFC Bank asset book is headed?
At the time the merger was announced, if you recall, right on your channel and also on your sister newspaper, so to say, we had made a specific comment on this issue. We said that there were a certain set of credit charges which IDFC Bank is yet to take, but the key quote which you had carried at that point of time is, "I count on Dr. Lal to take all provisions as necessary before the merger." I am happy to tell you that the prior management did all the good job. They did all such provisions of close to about 600 to 700 crores through the profit and loss account during their tenure itself, and therefore on the existing book of IDFC Bank, as far as our eyes can see at this point of time, there are no real bad accounts that are waiting to be taken through the P&L. Of course, it's a large book of about 60,000 crores, so you got to constantly watch that book like a hawk, but nothing that should disturb you at this point of time.
It's too early to talk about what is the next big thing for the merged entity, but can I safely assume that you've already started thinking on building up a strong insurance franchise, an AMC business or a brokerage business? Eventually that's where you're headed?
The answer is none of these. We want to be entirely focused on banking, and as I see it, banking is very simple, and it should be simple. You're borrowing money from public at large, and you're lending it to the public at large or to large corporates. And I think you borrow at maybe 7% or so, you lend at 12% or so, you make a net interest margin of about 5%, and then you provide for your provisions and your operating expenditure and make a profit. So we want to stay truly very simple to this. Number two, as I told you, the current loan book itself is close to about 1,04,000 crore, of which the retail book is about 35,000 crores. In the next 5 years, I would like to share with you that we have set for ourselves a target of ₹1 lakh crores of retail book. The margins of the retail book are much higher, and as a result of such margin coming from a substantially enhanced retail book, we think we are targeting for return on assets to grow from about 0.1, 0.2%, that is what we have today, to about 1.5% in due course. We think that it is a steady state growth. You started the conversation by saying what should investors expect. I would say that people should expect a steady growth in terms of profits and a return on equity as the 5 years rolls out.
At a time when we are talking about a potential and a strong liquidity squeeze which has happened in the financial market and banks are slightly careful in terms of lending, how do you think the dynamics are likely to change in terms of asset liability mismatch? You've done a great job of maintaining risk, managing NPAs, but the terrain has changed, the liquidity constraints are back. There are concerns which clearly have emerged in various promoter group entities. So what is your understanding of the scenario on the asset liability side?
I would actually say that we talked of the asset quality of the IDFC Bank erstwhile book, and I told you that after the provisions things are fine. As far as Capital First loan book, which is getting integrated into the storyline, I must point out to you that for 8 years at a stretch, the gross NPA stood at around 2% and the net NPA stood at about 1%. So it was a very stable, seasoned book, seasoned over cycles and diversified over 7 million customers. Now, we think that story, when you fast forward it over the next 8 years or 5 years to compound that about 22 to 25% every year, we think that large book should be absolutely okay, should be absolutely fine. We expect to behave that way. Now, I would like to comment on the current environment in terms of liquidity and so on. I really don't see that really affecting the retail portfolio because two big things have happened of late. Number one, the emergence of credit bureaus is a very strong factor, and people are not defaulting on at will. And number two, with the emergence of analytics and databases, the ability to track the customers and be with pinpoint precision has dramatically increased. So with the emergence of the ecosystem plus a strong underwriting standards, honestly, I don't expect any problem in the near future as far as I can see.
And just to wrap it up, and I don't want to get this messaging wrong for our viewers and for your investors, you would be focusing on the retail franchise. You want to grow that franchise. That's where growth and that's where margins and spreads are higher. But what happens to the basic bread and butter business, the corporate end, the MSE end, the SME end? What are your thoughts there?
Those two will be growth areas. I told you what we will not do, so that it can be clear for you. We don't do investment banking, we don't do broking, we don't do insurance, we don't do either general or life, we don't manufacture these products, we don't do all those things. As far as core banking is concerned, we love to do retail banking. We told you for the reasons for that, and we believe there's a huge market there in all segments, and certainly the bottom of the pyramid. As far as wholesale is concerned, there's a very big market there, and we want to focus on that in a selective way. But certainly it's an important piece for us, and we would like to continue to grow that. There is one question before we sign off, which you haven't focused about, but if you don't mind, I'd like to clarify that to your viewers and investors. This quarter, the company has posted a loss. And there are questions going around that how come after merger, if you really saw the books of the bank, how come there is a loss on merger? I'd like to clarify that for the benefit of your viewers and investors. It's an important question to address. Here what has happened is that Capital First was quoting at a premium to its book value by close to about 2,600 crores at the time the merger was actually effectuated, maybe about a couple of months ago. And that premium of 2,600 crores substantially represents goodwill. When that merger has happened, if the combined bank continues to carry this 2,600 crores as goodwill, then the bank will not be in a position to declare dividends. So therefore, this 2,600 crores has been charged off to the P&L, but the net effect is actually neutral. And therefore, I'd like to point out there is no erosion to the net worth. The net worth of the institution actually has increased over the last quarter. Standalone was close to about 14,700 crores. It has now grown to about 18,600 crores. The net worth has actually grown, and that's the asset test whether any impairment has happened. So therefore, I'd like to clarify to your shareholders and to everybody, there has been no erosion of net worth because of the merger. This is a goodwill that got accounted as a goodwill on the top line and equally got charged off on the bottom line. It's a net neutral activity as far as shareholders are concerned, and I wish there is no confusion on this front. The last question going on social media right now was that is Capital First carrying a goodwill on their books which is being merged being charged off to the P&L now? The answer for that is also no. Capital First carried zero goodwill on its books, meaning it did not carry any of these intangible items on its books. It's nothing to do with Capital First. It is a premium paid to Capital First shareholders, which is being accounted for on the top on the goodwill and later being charged off. It's neutral to shareholders. In fact, the book value is actually, which would have otherwise been 37 rupees, has now gone to 38.25 because of the goodwill accounting. Just, I'm happy to have clarified that to you for shareholders.
You know, last time when we met, you also said the integration was on, that was keeping you busy, and I hope to see much more of you going forward on the channel. And by the way, are you back to your routine on for your morning jogs and morning walks on Worli Seaface, or the merger process will keep you busy?
Well, I must, honest answer is that it's been very stressful because for the last many months, you know, the early mornings don't permit us those luxuries. But I do hope that within the next 1 year we can get to that. I must say, not only for myself, but for many of the colleagues, without exaggeration, it's been anywhere between 12 to sometimes 16-hour days putting this integration to. But we are quite happy the way it has shaped out, and I'm very confident that when this merger is complete, you know, the results will be good for all, and we will be hopefully back to our normal schedule.
Good to have you. Good luck, and thank you for joining us.
Thank you very much. Thank you, Nikunj.